Welcome everyone, and so this is our YouTube live. We're going to be together for an hour, and you can ask any question you like within reason, as long as it's to do with finance. And I think I usually start these things with a kind of summary of what's going on in markets, and it's been about a month since we last talked, so I think I'd characterize this period as, a lot of people have been talking about what the Fed's doing, and there's been a lot of worry about inflation, and as usual at the moment, and we had a weak inflation print, so slightly below what people expected, and that caused a surge upwards in markets. But then markets realized that the Fed actually wasn't going to completely reverse its policy for the point of view of a 0.2% downside surprise on US inflation, and that this is going to be a long haul. It seems like markets have to be continually reminded of that, but still, we did have a big rally, and then we had another rally at the end of over the last few days. And I think generally markets have been grinding upwards, and if we look at valuations right now, you can see that they are quite they're getting a little bit more expensive. So let me just share with you some of these trackers which we use, which we now make available to our PensionCraft subscribers. So this is what they look like, and so there are various ways they work. You can do things like savings and retirements tools. We can look at stock valuation, macroeconomic indicators. We can look at what's going on in markets on a kind of risk return plot. And we've also got fair value models for property, gold, silver, and so on. But let's look at stock valuation right now. And what's kind of interesting is that we have been grinding back up. So it looked for a while like we were going to reach the 60-year average price to earnings ratio, but it just seems like, markets have kind of got ahead of themselves again. And maybe what we're looking at is another big bear market rally. And this will be the 1, 2, 3, maybe the 4th bear market rally we've had already this year. Why do I say that? Well, fundamentally nothing has changed. Earnings are being forecast, are being downgraded for Q3 and Q4. So that's not a positive look. Inflation is surprising, perhaps on the downside, and we are starting to see many of the components of inflation fall. So we should expect inflation to start topping out. But I think there might be a few fits and starts on the way to a very rapid fall of CPI, which is what many central banks are expecting next year, including the Fed. But certainly at the moment, we've pushed ourselves back above the 10-year average forward price to earnings multiple. And if you look at Shiller Cape, of course, things are looking very expensive. So the cyclically adjusted price to earnings ratio is still pretty high, not far off 30. And that's very expensive. If we adjust for real interest rates, that's what excess Cape yield does. And now the axes are flipped, so cheap is at the top, expensive is at the bottom, and the median here is the line which you can see separating the blue, which is the cheap bits, and the red, which is the expensive bits. What's interesting is that that's actually showing that markets are also a little bit expensive. Not a very expensive, but a bit expensive. And that's because real interest rates have increased a lot and prices have gone up. So, net, that means that markets look more expensive in the US, and they're certainly not a bargain. And they're not even at fair value according to this measure. They're looking a bit expensive. So we're back in the situation where the US is looking a bit expensive, and that is a bit of a worry. And I think probably what we're going to get is a little bit of a step back again to where we were before. So, I'd say that overall, if we look at things like the recession probability in the United States, there was a model that was published by the Fed, which looks 1 year ahead, and that's still flashing 85% as the probability of a recession in the US. However, if you actually look at the actual GDP prints, they're still holding up pretty well. And if you look at things like US jobs, that market has very much recovered. It's gone beyond where we were in terms of payrolls before the pandemic crisis. And non-farm payrolls has been pretty strong over the course of this year. And if we look at the individual prints, they've been pretty strong. Maybe they've gone down a little bit. So if we zoom in a bit more, you'll see the trend does seem to be downwards. So the latest print was 261,000 non-farm payrolls. And that does seem to be on a downward trend, which is what the Fed is trying to do after all, which is to reduce demand for labour and hopefully by reducing demand, it'll get the labour market back into sync and stop inflation being so high as it is now. So at least, that is encouraging from the Fed's point of view to see the non-farm payrolls gradually fall. So overall, the Fed is kind of tightening conditions. We are seeing that in the data. So it is getting to where it wants to be, but inflation is still very, very high. There's no question about that. So if we look at the actual inflation numbers, they are still, way above where the Fed wants them to be. So, CPI 7.8, core is also very high, over 6%. So that clearly is not what the Fed wants at all. But it does seem perhaps as if that's kind of topped out. So fingers crossed, things will start to improve in terms of inflation. So, I think the overall picture is one of markets which have got a little bit carried away with themselves again, and credit spreads also. If we look at the credit market, we've seen credit spreads tighten. So credit spreads are just telling us, no, we're not going to get a recession at all, which is also, I think, misguided. I think we probably will get some form of, certainly weakness in US growth, if not a deep recession. But it really depends on what happens with the credit cycle this time around. Usually that in itself can trigger problems in the US equity market, but also for the US economy. So that's a key thing to watch, those credit spreads. But people have been piling into junk bonds. They don't believe that there's a problem, but ultimately there will be, I think, because, with interest rates so high, the risk-free rate is now much higher. The credit spread, even if it tightens, still creates an all-in borrowing cost for low credit quality companies. So if their cost of funding goes up, the probability of default's higher, the cost of rolling over their debt increases. So I think we probably will see some form of credit cycle with more defaults, and that will have impact on the equity market too. So I think earnings is a key thing to watch. Credit spreads and credit defaults are another thing to watch over the course of this year and the beginning of next. And I think there are lots of possible accidents that could happen along the way. But I am getting more constructive personally, so I am accelerating my drip feed into equity, and I will be fully invested in equity in my core portfolio in 4 months' time. So I'm just going to ride it out. What's good is that markets aren't super expensive, which is where they were about 9 months ago. Anyway, so let's take a look. Hopefully Laura has, yes. So Laura's got a document here, which I'll be referring to, which has got the questions in it. So remember, if you do want to ask a question, if you do a super chat, you'll be pushed to the front of the queue. And if you want to, I like that. Laura's called it a supper chat. That sounds much more friendly. But a super chat you have to pay for. And obviously that helps us. So we do have to eat. And the other way to get pushed to the front of the queue is to be a supporter on YouTube. So you can tell if you're a supporter on YouTube, you have a nice crown next to your name with the PensionCraft logo, and we'll be able to tell you're one of our supporters. So either of those will be pushed to the front of the queue. Otherwise, you just have to wait till it comes to your turn. So the first question is a super chat, thank you, from Sagar Gadre, who says, what's your analysis of using multiple trackers to counter the US bias in the global tracker fund? What will be the performance versus global tracker? Thank you. Yeah, I mean, a lot of people are doing this. a lot of people I speak to are doing this. So the argument goes something like this, I think, in most cases, which is that, okay, the US, if you compare it to other markets, is looking expensive. So if you compare it to Europe, you compare it to the UK, emerging markets, and almost any other market, it's looking expensive in relative terms. So maybe that means that the US will now underperform. Okay, it's outperformed for the last 10 years by a mile, but you look at what's happening to mega cap tech, you look at what's happening to the US economy, maybe it's not looking so peachy for the next 10 years. So what people are thinking is, well, if I buy a global index, it's going to be 60% US. It has a huge US weight. So what I want to do is dial back my US weighting so I have less exposure to the US and I've got more to the cheaper countries. Because we know there's this inverse relationship between long-term returns, 5 years plus, of equity and valuations. So when valuations are expensive, you get smaller returns. And when valuations are cheap, you get larger returns. There's an inverse relationship between the two. So yeah, you can construct your own version of a global index with, say, a European fund, a Japanese fund, a APAC fund. So that would be primarily, if it's developed, it'll be Australia and South Korea, and maybe an EM fund. And that'll reconstruct almost all of a, maybe LATAM as well. And that'll reconstruct maybe a complete global index. But what's nice about it is you can dial the individual countries up and down and go for less of the expensive ones. Now, I do know someone who's been doing this, and Meb Faber talks about this. And Meb Faber claims that if you use a simple strategy where you just take, say, the 3 cheapest countries and just go for those based on, I've forgotten which measure he used, I think it was CAPE, then, that outperforms just a global index. So, you have to take it on faith that that works. Secondly, I think the problem is you have to stick with it for a long period of time for it to work. When I've done back tests of this, I couldn't get it to work. So I don't know if that's just the way I was doing it. But yeah, I've found that strategy was difficult to implement, put it that way. I think also from a kind of cognitive bias basis, it's a difficult strategy to implement, because if you look at the cheapest countries right now, it would be countries like Turkey, right? And China and Brazil. The countries which have serious problems, of course, are the ones which are the cheapest, the ones that nobody wants to buy. And it's not easy being a contrarian. It sounds a little bit like Kermit the Frog, it's not easy being green. But being a contrarian is very difficult. And I think that's the problem, Sagar, which is sticking with the strategy. When all of the news flow tells you that China's about to implode, which is actually my video for this Saturday about China's economic collapse, whether it's going to happen or not, and what investors should do. And all of the headlines are telling you, don't buy this, it's a disaster. And yet you have to buy it because it's cheap. So will that strategy work? Probably, if you stick with it. Another way to ensure that you don't go badly wrong is to not go too far away from the global market cap weights. So you don't have to go all in on the cheapest countries. You can just do a tilt to those countries. So you don't have to go, mad dog about this. You can just kind of tilt slightly towards the cheaper stuff, and that way you won't outperform if you're right by as much, but you also won't underperform if you get it badly wrong. So that's all I'd say. Be a little bit cautious, I'd say, at the moment about a big tilt to cheap countries, because some of those cheap countries like China have some really chunky tail risks that go with them. And by chunky tail risk, I mean capital control type risk, where, like with Russia, because of their actions on the global stage, they were essentially frozen out of capital markets and you couldn't pull your money out And I've had some difficult conversations with clients who had big exposures to Russia where, you just have to wait to see if you'll be able to get your money back. So I think that might happen in China. Low probability, I'd say. I'd say 10% or less chance of that. But still, it's a tail risk that's worth thinking about, and one that would scare me a lot. So please do like and share the stream, I've been told to say. So I'm looking at Laura's document. She beats me up if I don't say it. So yeah, do like and share. And obviously helps us a lot if you like the stream and if you tell your friends about it on social media. So please do share the stream, even if you're watching it in replay, because people tell me they find these sessions useful. There we are. So yeah, that's my answer to you, Sagar. I hope that was what you meant. Right, so now I'm going to have a swig of my drink. Oh yes. And we'll answer some of your questions. Oh yes, here's a good one. Can you comment on the recent Blackrock story from the FT regarding freezing withdrawals from their real estate fund? Do you think this might cause a contagion effect? Yes, let's look at that. It's kind of interesting. I like that story. And what's really cool about this is Robin Wigglesworth, who wrote the really good book on index investing and who's now in charge of FT Alphaville, literally last week wrote about the possibility that this would happen, and also the fact that Blackstone would start to suffer some problems. So let me just share my screen so you can see this, because I'm just talking and you can't see. Right, so this is the story I think you're talking about Blackstone. So what's happened here is a fairly classic example of a fund being gated because there's a liquidity mismatch. Let me just move my face over here. Good. Yeah, so this is a liquidity mismatch, a classic liquidity mismatch where you've got an underlying asset, which is the property, which is inside this Blackstone fund. And this was an immensely popular real estate fund, which brought in a huge amount of fees to Blackstone. So this is a private equity group, that's what Blackstone is, and this was their kind of central fund, possibly their most important one and their most profitable one. And it's called the Blackstone Real Estate Income Trust. And the problem with these illiquid investments is that it owns commercial property. Now, commercial property, if you can imagine, is not something you can sell quickly because, how do you sell a shopping mall? How do you sell an office block? There isn't a huge market for it. And if interest rates are shooting up, then, a lot of the companies which pay rent in those buildings will have to pay more rent if they buy it, if interest rates are higher. And, maybe they can't afford it, so the revenue falls, maybe they fall behind in their payments, they go into arrears, and then it feeds through into the commercial property market generally, which goes into a kind of meltdown. And then nobody wants to buy your illiquid assets. And that's what people are worried about right now. Higher interest rates, more arrears with people paying their rents, which effectively is why you buy real estate, commercial real estate. It's a way of milking the property for the rental income. And if that rental income dries up, why would you buy the asset? It's illiquid. So people are pulling their money out, but they can't redeem the investors quickly enough because they can't sell the stuff in the fund. So there's a liquidity mismatch between the fund and its assets. So yeah, what they've had to do is essentially gate the fund, which means that people can't pull out their money anymore. Now, the problem with commercial property is it's very illiquid and you can't find out what it's worth. So the prices are falling, but you don't know they're falling because you can't reprice your shopping centre on a daily basis because it doesn't sell on a daily basis. Whereas with the stock, it trades millions of stocks every day. It's very liquid. With these, it's impossible to see how much it's worth very easily. All you find out is when you go to sell it, you can't. So that's the fundamental problem. And it's interesting that the redemption requests, 70% of them have come from Asia. and that's a surprise because only 20% of the total assets are non-US investors only account for about 20% of the total assets. So it's interesting that people are panicking now, and so the kind of stuff it owns is things like MGM Grand Las Vegas, Mandalay Bay Resort casinos in Las Vegas, and that's one of the ones that it actually looks like it was going to sell. Yeah, so it looks like it's already sold that one. Yeah, so that sale actually went through. But I guess now that we have all of these redemption requests, it just can't sell the remaining assets quickly enough. So what does this mean more generally? I think more generally for the real estate market, for the commercial real estate market at least, it is worrying that they can't that we are seeing these outflows, because usually what you do get is a contagion. And if you look at the outflows, this is the article I was talking about by Robin Wigglesworth not long ago, and he was just talking about the Q3 results for the fund, and just saying that, oh yeah, Blackstone really wants you to buy it. Okay. But if you look at the actual is this the outflows for this? Yeah. So outflows in the form of repurchases of investor shares have slowed since the summer, but will continue to be closely watched as the fund matures in the face of a less constructive backdrop. So you could kind of see the problems coming. There were hints of it in the Q3 report, but I think this will be a rocky time for commercial real estate with higher interest rates, because all of these rate sensitive sectors like property are going to have to readjust to the new interest rate environment in which we find ourselves. We're not going back to zero interest rates, and this is just one of the growing pains of transitioning to this new era of higher interest rates, or I should say just normal interest rates. It's just that the previous decade was really weirdly low in terms of free money. So this is just one outcome of that. But yeah, I mean, if I had commercial real estate right now, I would be concerned. It depends on what sectors you own, because it's a very diverse asset class. But I would be worried if I had a comparable set of holdings in a comparable fund with big chunky commercial investments in a sector that perhaps isn't looking so good in this new macro environment. So I'd be worried about that. I'd be worried a lot about that. And I think contagion is possible. In terms of whether it'll cause contagion outside the real estate sector, that I doubt at this point, because these are fairly self-contained assets. They do rely on funding, but I guess the people that lend them money could get into trouble if some of the loans go bad. But remember, they are funded by investors in the REIT. So I think the prime contagion in this case is going to be within the REIT space. Mostly the kind of examples where you do get contagion beyond an asset class is when a company like a hedge fund owns multiple types of asset. One of them is illiquid and another one isn't, and they're forced to sell the liquid stuff because they can't sell the illiquid stuff. And I don't think there are many cross holdings with real estate funds and other funds, so I don't think that's a problem at the moment, but it's only something to watch, and it is worrying. But I doubt it's going to affect equity markets right now. Everyone's talking about this story, which is Powell's latest comments, which is that they're going to raise rates by 0.5% in December, and they are starting to talk about slower rate increases. But if you listen to his previous press conference, that's not inconsistent with what he said previously. So yeah, I think I wouldn't get too bullish at this point. Anyway, back to your questions, and I'll switch back to me. And we've got a super chat from Daniel Cooper. Thank you, Daniel, who says current views on global growth versus value. Thanks. Let's have a look at growth and value and just look at it over the course of this year. So again, I'm going to use these tools. So just give me a minute to fire this up. And what we're going to look at is growth and value funds in the US primarily. Now, obviously, value's had a terrible time of it over the last 10, 15 years, which is weird because it outperformed for over a century. So value was a great strategy for a very long time, and then suddenly it wasn't. Now, that had a lot to do, I think, with low interest rates. So one of the consequences of higher interest rates, many people believe, is that value is now going to be a better style of investing. And large cap tech companies, large cap growth companies are not going to be flavor of the month for much longer. So let's have a look at these sectors. So let's have a look at, we won't look at the indices. So let's choose factors. And what we'll do is just look at the last year. So let's do year to date. Now, actually, let's look at the long-term stuff since 2008. Now, what's interesting is that you can see that growth, large cap growth, the Russell 1000's large cap growth was where it was at, right? So huge returns over that period of time, 11.9% per year. So just far better than any other factor. And it's only when you get down to this part of the table, so value only appears when you get down here, and it has a growth rate of about 4 percentage points less than growth over this period of time. So, value, large cap value was 7%, large cap growth was 12%. So, yeah, that's 5 percentage points higher. Now let's turn to the most recent year. So let's just go over the beginning of 2022 to now. How accurate can I get this? That'll do. So up to November the 30th, very different story now. Value actually has lost less than many growth funds. So now the large cap value, S&P 500 value, is only down by 5.5%. Dividend yield, really boring value stocks which pay a high dividend. Remember, high dividend is another measure of value. Those two perform the best. And if we look at what's done worst, well, S&P 500 growth is down at -30. So very clear reversal over the course of this year. So the only question really, I guess, is whether that's set to continue. Now, personally, I think it probably is, because if you look at what was in value when it really started to take off, it was energy stocks, and energy stocks have done very well over the course of this year. And so have defensives like consumer staples, companies like the things that you have to buy even if there's a recession. Those have done well. So I think that kind of value approach is likely to carry on doing well. Because interest rates are now higher, and growth is going to suffer because valuations are still high for some of those growth companies as a hangover of where we were before. And every time we have a rally, growth kind of comes back. People are still hoping that horse which did them so well, which acquitted itself so well over the previous decade, will somehow get its oomph back, right? And give you another decade of stellar performance, 5 percentage point outperformance versus value. But growth, I don't think, is going to do well in this environment because it is still expensive in many cases. There's always a premium for growth, but at the moment it's still pretty high. It hasn't kind of capitulated, put it that way. And also, with interest rates being higher, that's just going to be a headwind for companies which are trying to grow aggressively. So I think, also with people being less wealthy, we're seeing savings being depleted in the United States, COVID savings, and we're also seeing less disposable income due to high inflation. People are paying more for their bills. So I think both of those are going to make it more difficult to get very aggressively growing earnings. So people naturally will move to something which is safer, like high dividend as a style. That's a style that's done very well this year. And things like value. The unloved sectors, which were which were about selling material things like energy or materials, which were really boring. Nobody wants to invest in those things. Maybe it's because of ESG, maybe it's because tech was just exciting. But suddenly those are becoming sexy again. So the boring stuff is sexy. And as somebody whose USP is boredom, I think that's great. So yeah, I think that value is actually likely to carry on doing well. That would be my guess. But look, I don't take big value or growth tilts in my core portfolio. I do that in my fund portfolio. Because I think it's difficult to stick with those strategies over a long period of time. I mean, someone who's stuck with value over the last decade would be an incredible investor, I think, even though it was underperforming, because they had faith that it would eventually come back. I think it's very difficult to do that, to stick with the strategy. And if you chop and change between strategies, you're likely not to win, because timing it is almost impossible. But yeah, global growth versus value. Yeah, I'd go down on the side of value. Ooh, Michael Pugh's on the live stream. Hello, Michael. He's my co-host on the Many Happy Returns podcast. We did an interesting episode recently. Let me just share that actually. Let's see if I can find Many Happy Returns. We also said that it's probably the worst named podcast ever in terms of timing, because literally we launched it at the very top of the market and the returns have not been happy over that period. So let me just show you the latest episode we've done. And here it is. So this is our latest episode, which was about balancing priorities and investing. So things like risk versus return, or liquid versus illiquid, or ethics versus diversification. Some really interesting juxtapositions which Michael came up with. He's really very good at coming up with these ideas, things which I normally wouldn't think of, but it was a really interesting episode. We also did one which was like the World Cup. I've got no idea about football, but Michael very kindly explained how fixtures work. But it was kind of like England versus France. So we were pretending like it was a football match, deciding which country's equity market was best. That was great fun. So do listen in to our Many Happy Returns podcast when you're out and about, walking the dog, whatever. I think you'll find it entertaining. A lot of people say they think it's funny. Okay, so a lot less serious than my usual videos. Hi, Michael. And back to me. And how are we doing? Right, so back to your questions. Right. Next question. With yields falling back, is it still worth drip feeding into a US Treasury bond fund? I think so. I think you've got to think about why you're holding a Treasury fund. Why have you got bonds in your portfolio? Is it because you don't like volatility, the volatility of an equity portfolio? In which case, yeah, it still makes sense to drip feed into it, because the reason why you hold it is because it dampens usually equity market falls. And when inflation comes back down, you will see this decorrelation between treasuries and equity. At the moment, with inflation still above 6%, yeah, they're highly correlated right now. So the diversification argument for holding treasuries is just not there. But I expect that's going to change over the course of 2023 as inflation falls, and they will decorrelate. But is it still worth drip feeding into a US Treasury bond fund? Yeah, I'd say so. If we look at the yield curve in the US, let's just get the latest yield curve just to see where we are, just to see what kind of returns you can get in the bond space. Here we go. So this is the UK yield curve, and somebody recently was asking me about, whether it's worth getting 6-month UK gilts. They look pretty tasty, don't they? They've got a 3.8% yield, so you could lock that in today if you buy a single bond. So that's certainly something to think about. But let's go back to the US. So let's pull up the US yield curve. Oh, interesting. So this is the inversion everyone's talking about, where the kind of short end of the curve is above the long end, which is usually a signal of recession. Yet another signal of recession that never seems to come. So 6-month US Treasuries, yeah, they're giving you 4.7. Gosh. And 2-year gives 4.3. So just by buying, say, a 2-year or 1-year bond, you can buy them via Treasury Direct. You can lock in that rate, so you can lock in 4.3%, hold it to maturity, and build a very simple bond ladder with like 2 rungs in it, a 1-year, a 2-year, and when the 1-year matures, you put it back into the 2-year. Depends on what yields are at the time. You might choose not to restoke your ladder. But yeah, I'd say that's, it's negative real return, of course, but it is very safe, particularly if you hold it to maturity. So that's the beauty of holding a single bond, a single US Treasury, compared to a fund, which is that the fund doesn't give you the choice about whether to sell. So you don't have the choice about whether to hold it to maturity. But the beauty of bonds is you don't have to sell them ever again. You hold it to maturity, you know exactly what you're going to get, you know exactly when you'll get it, and you know what yield you're locking in today, the day you buy it. So I think, a lot of people, certainly in PensionCraft, on the Slack channels have been talking about buying single bonds for this reason, because you can lock in a rate, hold the bond to maturity, and earn a pretty good yield with very, very low risk. The only risk really is an opportunity cost. So if you buy a 2-year Treasury at a yield of 4.3%, then you've locked in that return. The only drawback is if equity markets surge upwards, so there's an opportunity cost there, or if yields surge upwards, because you don't care, because mark to market, it doesn't really affect you. You're going to hold it to maturity anyway. You do care because other people or you could have got a high yield if you'd have just waited a little bit. So it's kind of an opportunity cost risk, but yeah, you'd miss out on it. But still, you wouldn't physically take a loss. You'd have locked in the 4.3%. So yeah, an interesting question though. I like that. Thank you. Right. Oh, another interesting one. Johnny123. Now this is a serious one for many people. Oh, there's a member question. I better answer that. Thank you, Blue Thunder. Great name. He says, hello Ramin, I hope all is well. Yeah, wonderful. Could you use cash in a savings account instead of a global bond fund? What are the pros and cons of doing this? Well, what you can, obviously if you're based in the UK, there are lots of cash products. So let's just have a look at these. You're not going to get much for it, admittedly. So let's look at NS&I. So this is, really boring, but good because of it, right? So you can buy these cash deposits effectively. I'm not a big fan of premium bonds, but they do have cash products as well. But the beauty of these products is that if you do buy something like premium bonds, is you get these kind of tax-free prizes with a certain probability, which is very low, 24,000 to 1, for every £1 bond that you buy, and a low interest rate. But there are tax-free benefits to owning these, and they're guaranteed by the UK Treasury. So as far as risks go for deposits, that's as low as it gets. Then you've got things like cash ISAs. So cash ISAs, again, boring, but you are getting better rates now than you used to. So I was looking with a client recently, you can get about 2.5–3% on a cash ISA. I mean, the drawbacks are that you'll probably get a lower income. I mean, we already saw with the 6-month gilts that you could get more than 4%, where you lock in your money for 6 months, you wait to maturity, and that's your rate. And that'll be higher than it would be for something like, probably, for premium bonds or for a cash ISA. So that's another way to go. However, if you have a bond fund, a global bond fund, all sorts of things could happen. If yields go up, the price will go down and you take a hit, because the price of the bond will fall, the price of the bonds in the fund will fall, and you'll take a hit. You don't have a choice about when to sell, and you just have to take the hit. So that's the drawback, which is the maturity, the duration risk. So what you can do is get a shorter duration bond fund, but then you get a smaller yield usually. However, with the inverted yield curve, maybe that's not so bad now. So if you do go for a short-term government bond fund, global, then you could potentially, let's have a look at just ETF. You could potentially be able to make money out of the inverted yield curve. So let's have a look at bonds, and what we're going to do is go for govies, government bonds, so very safe, and we're going to go for 0 to 3 year, and we'll sort this by expense ratio. So if you're a UK investor, you may not want to take the currency risk, but this will give you 0 to 1 year US Treasuries at a fee of just 0.05%. Here's another one from iShares. Again, the fee's very low, 0.07%, and it's a pretty big fund, so it's not going to cease to exist. An accumulation fund. Is there one in sterling? There's a sterling hedged one here. The fee is still 0.1%. 0.1, 0.1. And that'll give you exposure to 1 to 3 year US Treasuries. Sterling hedged, so if sterling strengthens, you're not going to take a hit. And that might be kind of interesting right now. Again, this is going to give you a safe small income, and the yields are now higher than they were. This is something you wouldn't even thought about, 9 months ago. But because yields are so much higher now, then it might be worth considering. Let's have a look at the chart of this thing. Yeah, that's not very helpful, is it? Yeah, but this is a distributing fund, so you wouldn't expect an accumulation one would be better, because we could actually see the income pushing up the price of the fund. But you get the idea, right? You can go for the shorter duration treasury funds or gilt funds if you can find them, and that way you can earn more potentially than you could with a cash account. But that's really what you're comparing. What's the risk you're taking? Are you taking currency risk? Are you taking duration risk? And are you getting compensated enough for taking that risk, those risks? That's really always the calculation with fixed income. And what's good about fixed income is the risks are very plainly laid out. The duration of the fund, the currency of the fund, and the issuers of the bonds in the fund. Is it a safe government? All of those things are what you'd consider. So I hope that answers your question. Whereas with the cash ISA, you're going to get much lower rates, I suspect, at the moment. But the benefit is that you don't have any duration risk at all. So if interest rates rise or fall, you don't really care. If short-term interest rates rise, obviously you do care, because that's good. You get a higher income. So it has those benefits. Another question from a supporter. Thank you, Adrian Cook, for supporting us. And Adrian asks, is this a good time to sell call options with the upside potential seemingly low and volatility high? Could buying a QYLD accomplish a similar outcome? Let's have a look at QYLD right now. So if I pull up QYLD, so let's have a look at QYLD, but let's explain what it is first. Okay, so this is QYLD. So what is it? Let's just pull up the actual web page for it, because the issue has a good description of what the fund does. So what is a covered call ETF? Well, the idea is that what you do is you take an index like NASDAQ, preferably a volatile index, interestingly, and what you do is you sell upside call options. What does that mean? Well, let's imagine that the index rises. If you don't believe that's going to happen, then what you can do is sell that upside to other people who do believe in it. So if you don't think the NASDAQ's going to go up by more than, say, 5% over the next 6 months, you could sell a 6-month call option with a strike, which is, say, 5% above today's price, and let someone else have that upside. Why would you do that? Because they pay you a premium. When you sell them the option, you get a premium up front. So by selling the upside, you get an income. So you sell the upside you don't believe in to someone who does, and that way you get to increase your income. And these option selling strategies are called yield enhancement strategies, where you own the index, but you sell part of the upside. And that's how these covered call ETFs work. Now, of course, the option always has to be sold because it expires. You have to sell another one. So there's a continual process of selling the option, selling the option, selling the option. And of course, the strike price varies over time according to the value of the NASDAQ. Why would you do that? Well, you do it for the yield. So if we look at the yield of this thing, you can see that the 12-month trailing yield on this is almost 16%. And so that's pretty chunky if you think about the NASDAQ. What kind of environments does this do well? Well, if it's a volatile environment, when the NASDAQ its price is fluctuating a lot, the options become more expensive. So when you sell them, you get a bigger income. The other kind of environment in which it does well is if it's kind of range bound. So if you buy the NASDAQ and it doesn't go anywhere, then what's the problem with selling the upside if it doesn't materialize? So in a range bound market with high volatility, that's like the dream environment for covered call ETFs. But what I'd be worried about right now is that, so if we look at QQQ, which is the NASDAQ tracker, and look at the price of that. Let's zoom in on that. So this is QQQ over the course of this year. And I've compared it with Life Strategy 60, just ignore that. And I'll remove that. Add, and I'll take away the additional graph, just so you don't get the Life Strategy thing there. Okay. And actually, why don't we add QYLD to that? That could be kind of interesting. Because it shows you when these things actually work. So if we create an index, which is LD, and we'll use the US one. There we go. Right, so let's just look at, so you can immediately see over the long term, NASDAQ has outperformed the covered call version. But over the course of this year, actually, there's not a lot of difference between the two. The NASDAQ's had these kind of rallies, the bear market rallies that we discussed at the beginning. And during those rallies, you can see that the option which has been sold reduces the upside for QYLD. So it doesn't participate in these rallies. But the beauty of it is that during the periods when it's range bound, it'll gradually start to outperform because of the higher income. So what this doesn't show you is the total return of this fund. This is an income fund because all US funds are income funds. What you can't see is the return due to that income, which would actually push QYLD above QQQ during these kind of sideways periods. So if only we had kind of QYLD equivalents in the UK. I don't think we have many covered call options in the UK. But I'd say this is a good environment unless you believe that there's going to be another one of these huge rallies for the NASDAQ. Because that seems to be what happens. You know, people keep thinking we're going to go back to this mega cap tech rally because, you know, why wouldn't you think that? That's what's happened recently. But I think that's unlikely. So I think, yeah, this is a good environment for QYLD. Yeah, so I like it. You know, if only I could buy it, but I don't think I can, unfortunately. But still, interesting strategy, yield enhancement in this kind of environment. If you do think we're going to be range bound in markets, if you think markets are going to tear upwards, then no, you wouldn't go for a covered call option because you want to keep the upside and participate in it. Brilliant. Okay, so back to the questions. We've got 7 minutes to go. Don't forget to like and share with your friends. Please do. It doesn't cost you anything and it helps us a lot if you do share and like the stream. Right. Quick drink. Yeah, this is a question I wanted to answer, which was so interesting. So this one is from Johnny123, who says, if you're about to retire, what should people do with the cost of the pension pot dropping? So the value of the pension pot dropping. This is a problem, right? I mean, if you've... So the problem essentially is one of sequencing risk is what they call it. But the idea is, let's imagine you're about to retire and let's say that the returns in future are fixed, but there's one return which is a real doozy. There's a 50% fall. And you can position that 50% fall either at the beginning of your retirement period or at the end. Now the problem is that if it happens early on, it has a much bigger impact on how long your pot lasts. And that's because if the market falls and you're selling some of the funds in order to eat, you know, to live, then you crystallize that loss. And that means that over the, you know, remaining 20, 30 years of retirement, that money has less time to compound because there's less equity in the pot left over. Whereas at the end of the period, it kind of doesn't have a big effect because you've already had the compounding and it doesn't really have to last much longer anyway. So this is sequencing risk. So this is why people say that just before retirement, you should de-risk. So how much should you put aside just before retirement? Look at how long drawdowns last for equity markets and just see how long you think it lasts. And set aside, you know, that amount of times living expenses in a very safe liquid form like cash perhaps or short-term government bonds. And that way, if there is a crash after retirement, you can eat the safe stuff, let the equity recover, and that way you don't crystallize the loss. So that's one reason why people de-risk just before retirement. But if you're already in the position where your pot has fallen, you know, I'd say, you know, has everything fallen? Have you got some safe stuff which hasn't fallen as much? Maybe short duration government bonds, maybe energy funds, which energy exposed sectors, you know, those are the things which have held up fairly well this year, or high dividend yield funds. You know, maybe there are funds in your portfolio which haven't fallen so much. Maybe you could live off those. Maybe you should dial back on your spending. This is the guardrail principle, as it's called, where if the size of the pot falls, what you aim to do is to take less out during those crashy periods. That way you crystallize less of a loss. But you can see the general principle here, which is don't sell the stuff which has fallen if it's equity, because that's going to affect your long-term survival of the pot. That's the kind of guiding principle. So if you've got alternative sources of income, buy to let, if you can possibly live off those, or even go back to work for short periods of time, part-time maybe, anything which you can do to reduce the amount you're selling or crystallizing in terms of loss, that'll help you. But it is a very difficult situation, and many people are in this situation now because equity and bonds have fallen together. Many people bought into the growth style of investing with Bailey Gifford funds, for example, and those have suffered a big setback this year. So yeah, not easy. And I have had that conversation with some clients, and there is no simple solution, but those are the principles. Don't crystallize the loss if you can avoid it. What else do we have? We have no more members' questions, so we have 3 minutes to go. And I'm going to choose one more question. So while I swig some of this, I'll read. Somebody saying some banks offer better rates than others. Usually go for the highest easy access account myself. Yeah, obviously you'd shop around. There are sites like Money Supermarket that give you the cash ISA rates, and you just look for the best. Okay, final question from a member. Great. Thank you, Adrian, who says, how does a trend following ETF work? CTA is a ticker of a fund that does this apparently. Yeah. Okay, so previously, you could have bought let me see if I can find the CTA ETF. Yeah. Here we go. Okay, the idea behind a trend following strategy. So these are managed futures. Let me just share this so you can see this. So what is a managed futures ETF? Well, previously, before this ETF existed, you could have approached a managed futures fund manager. And the idea with futures, the really nice idea, is that you can be long as easily as you can be short. It's just a matter of buying or selling a contract, right? And they're very liquid and they're all margined, so it's fairly safe from the point of view of the exchange. But the idea is you can go long as easily as you can go short. In other words, if markets are trending up, you go long. If markets are trending down, you go short. And assuming that you can call the trends, you can outperform even in a falling market by going short. So as long as the managed futures strategy manager, presumably the guys who run CTA, can call that direction correctly, then you can make money in a down market as well as an up market. So let's see what's in it. So systematic long short managed futures, so you can go long or short the market. Does it tell us what they buy? So they've got some kind of model which tells them when to go long and short. It invests in US and Canadian commodities and rates. So it's not equity, it's purely commodities and rates. So you go long. So here we go. So these are the models which it uses. It's got a mean reversion model, a carry model, which presumably borrows cheap and sells. So borrows at a low rate and lends at a high rate and generates income. Risk off is when equity markets presumably are falling and risk appetite's falling. When there's a price trend, so if there's a strong trend in the price, it'll get on top of that. So it looks like it's a kind of regime switching model which tries to detect the regime and then switches to the exposure which will do best in that environment. So it really depends on whether they get the call right. And presumably they have recently done well. Here you can see what they've actually got at the moment, and these are government bond futures. And we've also got a little bit of commodity exposure. So yeah, that's what it gives you. But really you've got to put your faith in these managers to call the directions correctly and to have a good model. But what some people do is they kind of layer this on top of an equity strategy. So you've got some long equity exposure, maybe via leverage. So you don't need to invest all of your money to get 100% equity exposure. You buy a levered fund, which you invest less of your money into. And then with the money that's left over, thanks to the leverage, you invest in something like one of these CTA funds. This is what Corey Hofstein calls return stacking, right? It's an old idea actually, but he explains it very well, I think. But this in theory should give you a kind of boost even in a down market. So it provides a little bit of a hedge, and it doesn't provide a drag in an up market because it can go long as well. But the idea is that this is uncorrelated with the equity components, so it gives you diversification too. So it's an interesting strategy. You know, I don't do this, but it might be interesting to look at this in future videos to see how well that's done. Or maybe even to interview Corey, that would be fun. But anyway, look, I'm out of time. I'm 3 minutes over. I said I'd be here with you for an hour. Oh, we've got a super chat. One more, and then I'll go. I've got money stuck in a LISA for exactly the next 30 years. Oh dear. As it's so long, I can commit to factors to beat the market. Is small cap value the best option, or multi-factor ETF like JPLG? Well, yeah, I mean, if you can see through the volatility, you won't go far wrong by using something like small cap value. Do you need to beat the market? The thing is, if you're in there for 30 years, isn't 6% real return enough for you? Because that's probably what global equity will give you. You know, do you need to take a gamble on small cap value? But yeah, historically, small cap value has done very well over a 30-year period. So yeah, maybe it's worth a punt. But, you know, just think about whether you need to do that. Would global equity do the job? And it's fire and forget, right? You just leave it in there and you don't have to think about it for 30 years. Think about the upside, Stevie. Oh my goodness, but that's a long time to be locked into it. But JPLG is an interesting one. Let's have a look at that just quickly. Yeah, I've come across this before. This is the JP Morgan multi-factor fund. And the performance has been quite good for this. And let me see if I can find the fact sheet for it, just to explain what it does. And then we can have a look at it together. JPLG, I'll accept all the cookies. And I'll go to the UK site. I'll accept all the cookies again. I'll accept all the terms and conditions. Yes, good. And I'll share this with you. So this is JPGL. I think this is the one you meant actually. So what does it do? The value of equities may go down as well as up in response to the performance of companies. So what does it do? Is it tracking an index? Let's see if it explains what it does. With any luck, we'll be able to have a little bit of insight into how it actually chooses the strategies. Let's have a look. Oh, this is it, right. Blah, 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 blah. The index is comprised of large and mid-cap equity securities. Certain factor characteristics more strongly when compared to the peer group. That's not very helpful. So I guess this is actively managed. You know, they maybe switch strategies. I'm not sure by just looking at it. Yeah, I don't know, to be honest, about this particular fund. So I don't think I can tell you much more than what we see there. But yeah, I think if you are locked in for 30 years, just consider whether you really need to have some kind of factor tilt. Because, you know, this fund might not be around for 30 years, whereas a global market cap weighted benchmark would be. So if you just buy MSCI World or FTSE All World trackers, you know, that's going to get you there and give you a pretty good return probably over a 30-year period. But look, I'm way over, 7 minutes over. So thank you all for joining us. I really appreciate your time with us. Thank you for watching. As always, I hope you've learned something tonight. And please do share and like, and do consider joining our membership. You know, that's lots of fun. And we get lots of interaction together via Slack. But also you get members only videos. And you also get access to those tools which I showed you at the beginning as a member. So to learn more about that, just go to PensionCraft.com, our website, and we'd love to see you as part of the membership. And good luck with your portfolios. So see you in a month's time, everyone. And don't forget, we've got a video this Saturday, which you may find interesting. It's about China. So take care, everyone, and do watch the video, and please do join the membership. Bye-bye.